one thing I can tell you from my perspective, contrary to what you believe or hear out there, people make more money now. Look at dual income families. In the past, it would be closer to the average middle income family earning about 120 to 140. And now it's much closer to about 160 to. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. Well, the big question is, will 1.2 million Canadians who have mortgages coming up for renewal have a heavy impact on the housing market? If you were not paying attention to the press clips and the press releases in the last week or two since the Royal LePage released its consumer survey, the headlines are virtually everywhere. Canadians are going to be broke, more or less. That's what they're saying. Now, the question that I ask, or that is being asked and posed to this episode is that actually the case? And are Canadians going to lose their homes? Is this going to precipitate the housing crash that many are calling for? And when you combine that with Trump's tariffs and rates that don't seem to be continuing to go back down, should we be concerned in the housing market of what's going on? Some are. And the question really most are asking is, should everyone be? And should most Canadians be scared? You know what I think about that. As the opportunist, I always see different ways and opportunities for people to be able to come through these things, but there's also a realist element. Is this actually going to be a problem? Should we be concerned? And is the market going to drop off a cliff? Let's get right into the numbers here. First and foremost, I'm not going to make you wait today. I'm going to spit it all out. First of all, the Royal LePage Canadian report. Let's talk about some of the highlights here. 1.2 million mortgages are going to renew in 2025, with 85% originally secured when rates were well below 2%. Those numbers are crazy. If you think about that today, especially with rates in that 4.5% range, below 2% is wild. And in some situations, crazy enough, some of these folks had a point where they were under 1% with those crazy low interest rates. 57% of mortgage holders expect their payments to increase 35% slightly think so, and 22% are concerned that it's a significant increase. Out of those surveyed, 81% of those people facing higher payments say it will put a financial strain on their household. And I want to stop on that for a second, because the thing is, if you didn't already see this coming, or at least most Canadians didn't see this coming, this has been coming a long time. You know how long your term is, whether it be 2, 3, 4, 5 years. And we've known about rising rates since 2022. So this certainly is a real thing, but it shouldn't be overly shocking for some Canadians. The interesting other stats that showed up here, 40% of borrowers expect their payments to stay the same or decrease, which was an interesting note, probably because those were on adjustable rates or variable rate mortgages, or they're planning to re-amortize their loan. We'll talk about that later. And interestingly enough, homeowners in Quebec, of all places, are the least likely to expect a financial strain, while Saskatchewan, Manitoba, and Alberta specifically are the ones that are most concerned about what's going on. I mean, let's start off right there. Most Canadians in Quebec not concerned, Alberta concerned. I think the big question right off the bat is, how are Canadians coping, and what are they planning to do to cope for these things? And the survey talked about some of the things that Canadians say that they're doing, but interestingly enough, when you look at the most recent inflation reports and you look at consumer spending, it doesn't seem like the two are matching together very well. I mean, people are talking about cutting back on restaurants, travel, and entertainment. They're considering downsizing or renting some of their home. We've seen some of that actually happen already, but I think the big question for most people is, if you're renewing this year, what are you planning to do, and how does the current rate market actually impact what your goals are? You know, it's been about a year since I started to see personally and anecdotally a number of renewals come in the door. And a few things that I've noticed just from my own personal perspective is that the vast majority of the people who are coming up for renewal, they don't know what to do. So they have no idea, what can I negotiate? Should I change things? Could I re-amortize? Should I consolidate debt? And I think the first thing for most Canadians is just generally, just like anything else, is getting the knowledge, which is the point of these podcasts, these episodes, of what your options are as it relates to your mortgage renewal term. So the first one is like, what can I do? The second one is like, do I need to requalify? And then obviously we'll talk about that for a second. The third one is what do I do as far as like the mortgage market, the rate market? And that's where that whole tariff situation and fixed versus variable, what's the right move situation really comes into effect here. So, without going too deep down one road or the other here, I think what I found interesting as I kind of just shift through this particular consumer survey is they said that Canadian homeowners plan to cope with payments based on, like, literally 2 out of 3 people said they're going to cut discretionary spending, which means they're tracking their spending and they're going to cut off things like, random restaurants and random purchases that are unnecessary. 43% basically saying they're almost going to eliminate travel. Now, that's pretty notable. And an interesting thing from my perspective, when I booked a recent trip to Mexico for a conference that I was speaking at and then staying at a little bit longer, I noticed the price was significantly higher than when I had done this a year ago. And I was talking to my travel rep about it. And I said, like, what are people doing? Like, this seems like a significant increase in the last 2 years in pricing. And she said, they're just paying it. People are spending the money. So when, folks are saying, hey, I'm going to cut down on travel, yet they're paying significant costs for a Mexican vacation, those two don't really seem to connect. And I think the question mark is Canada about to go into a whole whack load more consumer debt, or are people actually going to make a change is a good question to start asking. Because if they start going into a lot more debt, then there's no doubt that will trickle down into the housing market and the real estate market in some capacity or another, whether it be people offloading their properties and downsizing, or the alternative, getting creative, especially in a quote unquote supply shortage situation, and looking in different ways to be able to rent out their home, to make that extra income, to make that extra cash that they've been thinking about for a long time. Other percentages here, some people were saying they're going to cut back on savings and investments, which doesn't bode well for those people who are looking to invest. I mean, I think in these times, you really need to find ways to double down and figure out where and how you can do that. 34% will be reducing spending on essentials like gas and groceries, and 23% will seek additional income like a second job or a quote unquote side hustle. Like, let's just think about this for a second. Compared to where Canada was, like literally in 2021, where people were spending money like it was going out of style, the government was giving away money. And now we're in the exact opposite circumstance where people are in that place. And so I think the question has to be asked, is this actually what's going to happen? Because part of this really comes back to the conversation of inflation. Remember, as you know, with carbon taxes coming in April, with the US-Canada trade war risks potentially weakening our dollar, and with the economy potentially slowing down, there are so many different signals out there that it's really tough to get a read on where the market goes and how it counteracts with this, and particularly how the average Canadian deals with this. But one thing I can tell you from my perspective that I know most people won't actually talk about is, contrary to what you believe or hear out there, people make more money now, like significantly more money. If I was to look back at my applications from 2019 and fast forward to 2025, I can tell you that it's not only the type of people I'm dealing with, but the average person I'm dealing with, and this is non-quantifiable, I'd have to look through thousands of applications. But if I had to just kind of guess and look at dual income families, in the past, it would be closer to, the average middle income family earning about 120 to 140. And now it's much closer to about 160 to 180. Yet, interestingly enough, people tell me that they feel broker than ever, because I think there's a number of factors. One, the costs and expenses, everything has risen in price. Two, people got used to spending money because money was cheap. So it's like you create a habit in doing so. And then number three, I think the reality is that our money is going out our back pocket just as fast as going in. We talked about inflation. That's a real thing. And with things that are going on right now, it doesn't seem to change. So that leads to the next question. Like, people are coming up for mortgage renewals, and there's this fixed versus variable rate question. But before I touch on that, I want to give you like a real life scenario for you to think about here for a second. So let's think about this like a side-by-side comparable. Someone takes their mortgage in, let's say 2020 at a 2% interest rate, 25-year amortization, payment of just under $1,700 a month, so $1,695. When they renew in 2025 at a 4.25 ish rate with a 20-year amortization, they're going to see about a 46% change or increase in their monthly mortgage payment. So it's going to go from about $1,700 down to $2,475. I'm rounding the numbers to make things simple for everyone here, or easier to understand. That's a pretty significant change in one's budget, even with their income going up. Now, truth is, incomes have gone up anywhere between 25 to 35% too, but then so have taxes, so is everything else, and so forth across the corner. So I don't know that it's an exact calculation for all people that, of course, they're going to have made, 25 or 35% more money, but a 46% increase is pretty significant for a lot of people. And I've talked to a variety of people who have different conversations. So the next question is, okay, well, what do I do if my cash flow is my primary concern and I don't want to see my payments increase? Well, obviously a lot of different strategies you can look at. One would be refinancing to extend your amortization. If you did that, you brought it back to 30 years, you'd be looking at a monthly payment in the same terms and rates, although the rate would be a little bit higher. So just under $2,000, so about $1,975 approximately, which is about a 16% increase in your monthly payment. I mean, that is still an increase in terms of cost to someone's budget. But then you can bring in additional factors. Like, let's say, for example, there's a car loan. Those car loans now are like 8 years. I've seen 9-year car loans, 7-year car loans, and these types of things. And you could have a monthly payment of, let's say, $800 with 3 years left. So you can match your mortgage term. Now, you're amortizing that mortgage payment over 30, obviously. So there's strategies to pay it on faster. But if somebody had $30,000 remaining, $300, that would equate to a monthly increase in their mortgage of under $200, and it could reduce their expenses by $600, therefore putting them in a net positive cash situation. They could look at increasing to a 25-year or something like that. So my point is, there's a lot of different ways to really look at this. I'm just giving you 2 of probably 15 different ways that we could actually try to figure out those numbers. But there will be a noticeable difference in terms of like what Canadians will see and how they can impact their options. Now, back to that article or survey that they had there, the questions that I want to ask again are like, so the strategies that homeowners are using to handle mortgage payments. Again, I'm seeing the most common thing I'm seeing is, to be quite frank with you, is reamortization, restructuring, and so forth. But the most common confusion for people is like, what do I do as it relates to my particular offer? Like when you get an offer from the bank. And I've explained this many times, like the banks can offer really great terms on rates if you don't make a change. Now, that's not going to make a significant difference in your monthly payment compared to what it was before, but it will have some level of impact on your total cost over the term. Remember, the big reason for this is because mortgage renewals have become a lot more competitive than they used to be, whether there be switching lenders for better rates or just, the fact that banks are going to see so much money come off their books, but they're just not going to do it up front. So the first thing I tell people to do is obviously assess your goals, right? Like, is it to reduce your payments or just reduce your total cost? Have you figured out fixed or variable? Are you going to do this solo? If you're going to do this solo on your own without advice from, a team like mine or advisory perspective, then your biggest thing you can do, the only thing you can really do is negotiate, and you can go back to your bank and back and forth. And they're playing a game right now, which is basically you go get the offer, then bring it back to me, which is kind of a crock, but that's what they'll do. And they won't be aggressive until you are aggressive. And there's another part to this conversation is, okay, so if I am doing that, am comparing offers with my own bank, what are my options? Typically speaking, they're going to just provide you with a fixed rate or a variable rate at the term length that they're going to be pushing. The last few months, I've definitely seen more people asking about variable, but the offers from the banks have not been nearly as aggressive for a variable. Consumers are also not getting the cash backs and things like that they would if they were a new client. So again, I'm seeing some people still want to switch to a different lender because of those reasons. Regardless of that, though, it doesn't really fix the primary issue. And the primary issue here for most people is still, what do I do at that term, because I have either a cash flow situation or I need to start investing my money? Like, that's another big part of this conversation. People are like, well, I need to make a change to my financial goals and what I'm trying to do. And so if I consider the shift of the mindset, if I was to quantify it now compared to what it was, say 3 years, 5 years ago, 3 to 5 years ago, it was like, hey, give me some cash, let's refi, and I'm going to, go and do this, buy this property or spend some money or build, renovate or things like that. Today, it's like, I need money. I need some money right now, or I need to reduce my expenses. When I say I need money, I mean, I need money monthly, my cash flow. The second thing I've noticed is that a lot of people are asking the question, what do I do? How do I get out of this strategy? In particular, families that I work with between the ages of, let's say, 45 to 55 years old, where they only want to work for another maybe 10 years and they're trying to figure out what their plan is. Those are the families that I'm finding that we have the most strategic conversations with, yet we're dealing with those in their 30s and they're not even, unfortunately, considering what do I do from an investment perspective, which kind of scares me, because if you have no plan, you have no way in and no way out. And one of the biggest challenges with the world that we're living in, whether it be AI or Google or Facebook or ads or things like that, people are getting more and more confused about what actually to look for, which you'd think would be the opposite. It's like ChatGPT. You can know Like you can go to ChatGPT and you can ask it anything you want to ask it. But if you don't know the right questions to ask because you don't understand what your solution is, you don't know how to prompt it, then the outcome is only as good as the prompt. And I still think that the average person doesn't know how to prompt it. And that's where guidance comes in, which is a whole other tangent. But I think the role of the advisor will continue to be greater, but just different than it used to be before. You don't need me to tell you what's the cheapest rate in the market. You need me to tell you how to strategize to be able to make that decision and feel comfortable with your family with particular terms and options. Okay, let's get back to this whole fixed and variable thing. So here's some interesting facts from that survey as well. 66% of those renewing are planning to take a fixed rate, with 29% considering variable, which is up from 24% in the last consumer survey last quarter. 37% plan to take a 5-year term, and 19% plan to take a 3-year term, which is also pretty interesting here. So the question mark again is, and we talked about this recently, why do I go variable? Well, again, back to that whole situation with this whole tariff thing, with the potential of job losses, with the potential of inflation actually falling off, with people not being able to make the money, while the BOC is not going to be able to raise rates. Despite all of that, they would have to actually start cutting rates if there are these significant job drops. And the market, even though in March is still proposing that rate drops will possibly not happen in March, the market is still predicting 2 rate cuts. And if that's the case, then on paper, using a simulation, it's going to save you money. The Bank of Canada's 2 cuts, if you have a variable rate, will save you money. Plus, if you are in that flexible part of your life right now, you have that lower penalty guarantee at 3 months of interest. You could lock in at a later time. If you're comfortable with some of the volatility, it could pay off. But the flip side to that is you might want to avoid that variable rate conversation purely because those rate cuts are taking longer than most people expected. Although I don't argue that's not necessarily the case. I mean, I think rate cuts have come in pretty much in line with what we were anticipating, just at a different cadence than where we were at before. Although the concern that we have here is that the inflation risks are still out there. And that's where things lean into the fixed rate market, particularly as predictions from the markets propose that we're actually going to start to see bank rates go up, fixed rates go up, which is an interesting conversation around that whole 3-year versus 5-year consideration, because as of right now, the chart suggests that fixed rates are going to be somewhere between 50 basis points to 75 basis points higher in the next 4 to 5 years. And so I've actually seen more people consider 5 years despite the concern over these massive prepayment penalties compared to where I had seen it before. So back to the renewal conversation. Does this impact the real estate market? Does this floor the market? Are we going to see people sell off their properties? I think the answer to that question, generally speaking, is no. We're not going to see people, just throw their properties away. I think people will refinance. They'll find different ways to do it before they go and take that approach. But I do believe that this could shake up the market a little bit in a number of different ways. First and foremost, a number of the people surveyed suggested that we are going to see people start to find ways to rent out rooms in their house. They're going to do, even despite the rule changes, more Airbnb, adding a rental suite with some of these ridiculous government programs, which still to this day, most lenders have not adopted in their particular programs. Either way, I think more people than ever will find different ways to proceed. For Canadians, real estate is the foundation of their financial liveliness. And the reality is it's not going to get easier to hold real estate, but I think the trend of people owning and renting out a portion of their home or looking for that side hustle will be a real thing. But I also do believe that a large percentage of Canadians are going to take on more debt than they ever have before. I think the only way out of this mess, to be quite frank with you, is for most Canadians to start basically pulling up their socks and looking at different ways to get invested, different ways to get ahead. And I just generally don't think, no matter how much information or education that someone like myself puts out to the marketplace, I don't think people are really going to pay attention to it. That's one of the challenges in our community as a country, is we don't really pay attention to our finances, which is a crazy thing. In any case, I want to know, like, if you're watching this right now, if you have a mortgage renewal coming up this year or next year, what's your strategy and what's your play? Are you going to rent out a portion of your room? Are you going to sell your house and downsize? Are you in a situation where you just don't know? If so, hit the link below and I'll be happy to have a chat with you. The question mark for most people is unknown. It's a big question mark still. And I hope that this information can help us figure out what we can do, because again, at the end of the day, we're looking to find different ways to strategize and help people create better financial livelihood. So hope you enjoyed the episode. Leave me a link in the leave me a review, YouTube, Spotify, thumbs up, all that fun stuff. And I'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.